Welcome, everybody. Today is Wednesday, October 30th. This is the fourth quarter global markets and economic update. We're excited to present you this material. As we work through the slides, if there are any questions that you have, please put them in the Q&A. If you have a question, likely someone else does as well, you can ask your questions anonymously, so you don't have to feel uncomfortable about asking anything. It'll be helpful to get the second part of the conversation going. So let me jump right in. We start with the why. Why do we host this event? Well, we host this event because we care about you. And the focus that we have here is to show you factual and relevant data. We live in a time where data mining is part of what we're experiencing. When I say data mining, it's like taking a select part of a chart and trying to get a reaction out of it, as opposed to looking at all the data and saying like, okay, maybe that's not great, but in the grand scheme of things, this is where we are. So this is our focus so that you can feel confident about your long-term plan and have an accurate picture of the economy and where things stand. Okay, so here's our agenda. And you see that the theme is consistent, where we highlight the positive and the negative on a variety of areas within the economy. So the US, international developed, the emerging markets, fixed income, which is another name for bonds, the more conservative part of the portfolio. And then how are we applying this on your behalf? So we're going to cover all of these components. And let's jump right in. So we're going to start with the US and the good. And Brian, let you get started. I'll move on to the next slide here.
All right. So for US on the good side, so this is our graph of the GDP. And one thing of note that the GDP quarter over quarter as well as year over year is 3%, which is above the trend line of 2.1%. So everything is good as far as the domestic US economy. There's no concerns from a GDP or an employment, which we'll get into a little bit later, standpoint. As noted here, the consumer drives the GDP. About 2/3 of the GDP consist of consumer, you and I, consumption. So everything is looking well so far, and like I said, it's 3% year over year.
All right. Moving on to the next slide here.
So job openings. So job openings, even though it has come down a little bit, which we'll address a little bit later, we still have more job openings than we have people looking for work. So right now we have just a touch over $8 million job openings, and the current unemployment rate is about 6.8. So we still have a plentiful amount of jobs relative to people looking for jobs. And also just take a look, where we were here in the past couple of years. This is higher than historical norms. So we're still well above historical norms as far as job openings are concerned.
And I'll just sort of compound, Brian, to your point. If you look back at this chart goes all the way back to 1973. So over all these years, and you see where this stands now, 8 million jobs, and you look back all the way to 1973, this wasn't the case. So I just wanted to highlight sort of, how important it is to highlight how many jobs we have available. Okay, Brian, let me turn it back over to you.
Yeah. So this is the inflation. So right now, I know it might be a little difficult to see, but right now our inflation is at 2.4%. So as you can tell here, we had the sharp decrease from the COVID period, and then we have gradually tapered out, and we're trending towards the Fed target of 2%. But right now, there's no concerns with inflation. It's been tampered down. As you noticed, on here, both energy and core goods are both negatively with negative core inflation. So they actually have helped pull down inflation. So we should be seeing, folks should be seeing a little bit disinflation as far as some day-to-day activities like whether it's getting gas or basically core goods spending.
All right, let me move on to the next one. Okay, I'm gonna take this area. This is gonna be my section. So talking about the jobs. So we just highlighted that there are 8 million jobs. There are more jobs than people looking for work. The concern here is the 3-month moving average. So the 3-month moving average of new jobs coming out is trending down. This is also one of the reasons that the Federal Reserve lowered interest rates in September, was because of this trend of jobs slowing down. So this is an issue. We're going to see this number. We actually get a lot of data this week, so we'll see what the jobs number is later this week. But this is an area of concern that we're aware of, and you know, it's part of the reality. Okay, the next concern that we have, which is certainly something that we're seeing a lot on presidential trail, or the talking points, is deficit spending. So we are spending a lot of money. It's above average. So, and as it relates to the percentage of debt that we have, as it relates, so another name for GDP is our production, our gross domestic production. So what is the country producing? So we're spending close to 100% of our production. Well, our deficit spending is in that area. This is the Tax Cuts and Jobs Act from the previous administration. This tax law expires on December 31st of next year, 2025. We'll see what happens with tax law next year. This is something we talk a lot about in all of our meetings. If the tax reduction is extended, we will have even more deficit spending. If it's not, then we're still going to be above 100%, but to a slightly lesser extent. So long story short, deficit spending is certainly a concern. Okay. Next slide is household debt service ratio. So meaning what is going out the door. And then also, as you see below here, is delinquencies. So within the average household, so here's COVID. All of people's expenses went down because we were stuck at home. We weren't doing anything. We weren't spending money. And so now we're out of COVID, and you see this average here around 10%. It's, you know, certainly it's been higher, but it's rising. More importantly are the flows of the delinquencies here lately. And so you see auto loan delinquencies and credit card delinquencies are both trending up. Now, a slight number, but you see them trending up. Somehow, which I totally don't understand, student loan delinquencies has gone down. We were expecting this number to go basically not straight up, but like trajecting up, because this is the loan forgiveness time, and it's like, okay, you don't have to pay, and eventually it'll get back to this average number, you know, between 8 and something like 12%. So we haven't seen that yet, but here again, this will be something that comes, and student loan delinquencies are normal. They've just been very, very low here lately. Okay. So putting the summary together here, what's good about our economy is our production, our growth. The economy is growing by 3% in the second quarter, as well as year over year, which is hard to do. These are really good numbers. The labor demand is very strong. Like we said, there's over 8 million jobs available in the country, and inflation's coming down. 2% is the target for the Federal Reserve. We're at 2.4. So rising interest rates have really done their job. What's bad? The 3-month moving average is trending down, even though there are so many jobs available. Deficit spending is a problem. There's we'll see each of these candidates have their own plans for that. Doesn't seem like reducing deficit spending is part of either of their plans, but it is an issue. And then again, household debt servicing continues to tick upward, and we're aware of that. Let me pause here for a moment. As we work through our different slides, please add your questions in the Q&A. I see we have one question so far. We added a feature where you can upvote a particular question. So if you like that question, you can upvote it and let us know that you find that question to be important. So as we go through these slides, please let us know what questions you have. All right, Brian, having said that, let me turn this over to you.
So we'll switching over to international developed markets. So as you know, the Fed funds US had recently decreased rates. Same thing happened over here at the ECB, which is in the purple. They've decreased their rates, which is in the solid line here, and are expected to continue to do so moving into the next 12 to 24 months. Likewise, in the green area, this is the Bank of England. They have started their rate decrease as well, and are expected to, once again, very similar to the ECB, continue down the adjustments over the next 12 to 24 months.
The ECB is the European Central Bank. So
I'm sorry.
That's the other, component. So all the way back to Brexit. So the Bank of England is their own bank, and then the European Central Bank is for the rest of Europe.
And then for another market, was a developed market, was Japan. They had negative interest rates, and they've actually increased theirs slightly, still well below the 1% level. But they're in a totally different situation than really the rest of the world, as we'll look at a little bit later in the coming slides here. But they're expected to just tick upwards, but still no concerns. They're not going to anticipate to make any large increases, just kind of gradually uptick over time over the next year or two.
Okay. Moving on to the next slide here.
Yep. So this is the inflation for developed markets. Developed markets are all highlighted in yellow. So here, this was as of the end of September. So there's at the end of September, 2.5 for US. More recent is 2.4. So all the highlighted ones are the international developed markets. So in general, their inflation indexes have all decreased relative to the US. As you can see here, the majority of the developed international countries are below the US as far as inflation rate. Japan has ticked up a bit. Previous quarter was 2.8, now it's 3.0, which is another reason why they increased their rates here recently, to help tamper down their inflation, where in general, the rest of the developed markets have gone down, where the Eurozone has gone down from 2.6 to 2.2. United Kingdom ticked up a little bit. Canada went down by 0.7. Germany's 0.5. France went down by 0.5. And then Italy ticked up a little bit by 0.3, but their inflation rate's only 1.1. So in general, over the last year, their inflation rates have come down, and they continue to come downwards or more moderate as far as the levels are concerned.
Yeah. I mean, 2%, two, they're in the twos. So This is very good. All right, Brian, go to the next one.
Yeah. And then this here is the unemployment rate. So the darker blue line is the Eurozone. So as you can see here, over the last 16 years, this is over a 16-year period, the Eurozone unemployment rate remains at a low and it's actually decreased a little bit, remaining steady around that same standpoint for the last year and a half, 2 years. Likewise, this Japan is in the light blue. Their unemployment rate has stayed down and has decreased slightly. They had about equivalent to what they had over this period, but once again, over the longer term of the 16-year period, both the Eurozone as well as Japan's unemployment remains relatively low from a historic standpoint. So no concerns there with the employment factor. And as mentioned just in the slide before, inflation-wise, they're all looking relatively well.
Okay.
And then this chart, this takes the top 50 companies globally and looks at the top performing companies. This dark gray line is the international developed, and then the blue line is the emerging markets. So you can see here from a developed market perspective, for the last 6 years, the number of companies within the top 50 has been increasing or has increased year to date for the 2024 year to date. And emerging markets, which we'll get into a little bit later, also has a high figure. So internationally, and this is one reason why we stay diversified and look at not only the U.S. domestic, but also invest international markets, is, you know, the best performing companies aren't necessarily all in the U.S. 40%, 40 of the 50 or about 80% are outside of the U.S. And of course, you can see here, this is the average. It's well above average for year to date 24.
Excellent. All right. So I'm going to take this next section, and as it relates to the developed international, this is a slide from Fidelity. The biggest concern are what we call the bad actors. So China, Russia, Iran, North Korea, you see them here and how that affects international trade, and even seeing things like, you know, North Korean troops in Russia being trained. So the bad actors are working more together in their efforts, and they're the biggest concern. You see the defenders of Western democracy here. So this is the biggest concern in terms of overall trade. The non-aligned countries, I mean, they'll do whatever benefits them the most. But certainly the bad actors and how they've sort of consolidated and started to interact with each other is the biggest concern. The next piece, as it relates to developed and in the Eurozone, is the rate of wage growth and how precipitously it has come down. So the positive part about this, I mean, you see wage growth at 3.6%, and we saw inflation a couple slides ago was like 2.2. So it's anything that you want to see with a consumer is that their wage growth outpaces inflation. We all experienced that for 2 years, where inflation was getting ahead of our purchasing power, which is annoying and uncomfortable. So it's encouraging that the wage growth is higher than inflation. Just the rate of decline is the concern here, but still good that they're ahead of inflation in terms of their living expense. So here's our summary. The good within international is the European Central Bank and the Bank of England have both lowered their interest rates, just like we have in the US. We expect that trend to continue. We'll talk more about interest rates a little bit later on the call. The international companies are performing well and arguably performing better than many US companies. Of course, we have the Magnificent Seven, these big seven technology companies that are doing fantastic. But largely we see internationals playing a meaningful role in terms of growth. Inflation is coming down internationally, and the Europe zone and Japan have low unemployment. So all very positive things in terms of the economy. Again, in summary, the bad actors continue to work together, and the rate of wage growth is a concern. So all things that we'll continue to monitor. Okay, Brian, let me turn this section
So
over to
staying
you.
internationally, but looking at the emerging markets. So this chart here, I know it's quite large and busy, but it's comparing valuations around the globe. So valuation is really a factor of price over earnings. So individual company stock prices over earnings. So valuations would go down by either the price of the particular stock going down and or the earnings of the company increasing. So that would cause the overall, either one of those or both of those factors would cause the valuation to go downward. So you'll see here, US is over here. So relative to historic norms, the US equity market in general is overvalued. Over here on the right, you'll see the majority of over here is international, and then particularly international emerging markets. So you've got companies like countries like Hong Kong, UAE, you have Chile, China, Philippines, Singapore, Korea. So you'll see here a lot of these undervalued countries in general relative to historic norms consist of a lot of emerging markets countries. And that makes the situation around as far as emerging markets investing very favorable.
Yep.
Also taking another step, we looked at the GDP, the growth of the US earlier. This here reflects the growth forecast for a variety of markets. So you'll see the US here, while we're currently 3% year over year and quarter over quarter, our 20-year forecast is 2.1%. All these countries over on the right here, which have a much greater forecasted annualized GDP, anywhere from upwards of 2% up to 5%, maybe a little bit above a 5% over here, are all emerging market countries. So you've got Brazil, Thailand, China, Malaysia, Mexico, Indonesia, India. All of the expected growth for those countries is a lot greater than the development market countries that you see over here, which includes the US. So once again, that's another factor and another reason why we have a portion of the allocation in emerging markets, just because they do play a role in a diversified portfolio. And the situation right now is they've got low valuation as well as anticipated forecasted growth to exceed other countries in the developed areas, markets.
Excellent.
So to sum it all up, as mentioned, attractive valuations for emerging markets relative to historic medians. And then as far as the growth forecast, expected to outpace developed markets. The bad piece is primarily same situation as we mentioned for the international developed. The ongoing military and trade conflicts will continue to persist with the bad actors. And they impact the international emerging markets as well. So that's the main concern, really, that goes across both developed and emerging markets internationally.
All right. Let me pause here for a moment. We're about to shift over here into the more conservative part of your portfolio, so the fixed income. Please ask your questions. I see, again, we have one question here. You can ask your questions anonymously. You don't have to feel that, you're putting yourself on the spot at all. So feel free to put your questions in the Q&A and we'll be sure to go over them. Okay, so one of the things about our business is there will be 2 to 3 different names for the same exact thing. So so this word here, fixed income. This is or another phrase for the more conservative part of your portfolio. For example, bonds. Bonds and fixed income are exactly the same. And you can think of it that way is if you almost flip the letters, your income is fixed. So that's another way to remember the more conservative part of your portfolio. Okay, this is a little bit of a busy chart. So I'm going to annotate here and sort of walk you through how to think about this. This slide is walking us through the return, the total return or the appreciation of these particular types of bonds as it relates to an interest rate fall, no change, or a rise. On the left-hand side here, these are all the different types of bonds you can own. And so UST stands for US Treasury. So you can have a 2-year US Treasury, 5-year, 10-year, 30-year. This is investment grade corporate bond. This is a US aggregate bond. High yield. High yield means high risk. So there's some more risky components to that. Typically companies that want to borrow, but they need to borrow in order to grow. So there's some risk in this area. Municipal bonds are tax-free. So these are your cities and states that are lending. This stands for mortgage-backed securities, asset-backed securities. Leverage loans are very, very short-term loans. Okay, so want to highlight a couple of things. And if we just start and look at the 2-year, 5-year, 10-year, and US Treasuries, what you notice, so really what we saw a 0.5% interest rate decline in September. So we anticipate interest rates to continue to decline over the next 12 to 24 months. When you look at this dark blue and you notice the longer your term, you see the better your returns. This is one of the things that we did, and even earlier this week, you may have seen some emails from Schwab, which is, and the term for this, the time is called duration. So the longer your duration, the longer the term of the bonds of the time that you'll get, you'll be able to collect that interest. So this is, and then on the flip side, we've already been through this. So interest rates rose for those 2 years, and we were very short. If some of you remember on this call, we were buying CDs. We were getting guaranteed fixed income in the IRAs because we knew that interest rates were rising, and we did not want to be in this side of the graph. Okay, let me go on to the next slide and walk you through a little bit more. This is a little bit of a busy slide, but let me just sort of pick apart and highlight where to focus. It talks about the yield in this term called yield to worst. What this means is that this is the interest you'll collect in a worst case scenario. And if we look at these diamonds, the diamonds will tell us what that interest is. So here we have US Treasuries, which are essentially guaranteed. So you can hold US Treasuries, and the phrase is called clipping the coupon. So these types of financial instruments, you used to go to the bank and you would get a piece of paper and it would be perforated, and you would literally clip the coupon, go to the bank, and they would pay you your interest. That's where clipping coupons came from. And I love coupons. So let's look at some more. Here we have investment grade corporate. Not bad, collecting 5.1% interest. asset-backed securities here. Then you come to the more risky loans. The US high yield loans is paying 7.3% interest alone, and then leverage loans is paying 9.2. To walk you through the slide previously, when you see interest rates going down and bond valuations rising, that appreciation is separate from the coupon. So I'm going to walk you through a little bit more. So you can see that this is the area that we have the most energy and see most excited about these results. Okay, what's bad about high interest rates? Going back to the beginning, our deficit spending. So we're issuing all these government bonds, and there's a big appetite for government bonds. There's actually a concern that we're not selling enough for the people who want to buy them, but okay, we don't need more deficit spending. But what does it cost us? So this net interest, it costs us roughly $900 billion in interest payments, the mortgage, to fund the government. So this is our 2024 federal budget. We're spending just under $7 trillion. We're borrowing just under $2 billion. And the cost to do that is 13%. And Brian put this note here, June of 2022, so this is during COVID when interest rates were low, our interest expense was $400 billion. That's because interest rates were lower. And so that was 7% of the budget. So again, as interest rates go down, this net interest will go down. It's like refinancing the mortgage. The government's constantly refinancing their debt, so to speak, because they just buy back the bonds that are on the secondary market and issue new bonds. That's the wonderful thing about our country, is that we have our own Federal Reserve, so we can control how we issue bonds and how we take them back. Okay, so that's the biggest negative, which is the interest rate. So let me walk you through the summary. What's good as it relates to the more conservative part? We saw interest rates go down in September. We expect that to continue over the next 12 to 24 months. And Brian's going to walk us through this visual, but I'm using my hands to demonstrate that as interest rates go down, those bond values will rise. And because we had rising interest rates over the last 2 years, what are we going to do? We're just going to clip that coupon. We're going to take the interest that they're giving us. And if they don't load or interest rates, that's fine. We're still going to collect the interest. And the reality of higher interest rates is the net interest. So I just showed you that we're spending $900 billion in interest payments, but that number will go down in the next 12 to 24 months. Okay. Let's continue. I'm going to turn this over to Brian. Again, one last cue or request. Put your questions in the Q&A, and we'll go over them. Brian, let me turn this over to you.
This is how we're applying this information on your all's behalf. So here, as Chris talked about earlier, the impact of rising interest rates. So in this case, in our current situation for the next 12 to 24 months, interest rates will be declining. And in that case, it'll be the opposite effect on the seesaw is the price appreciation. So as the interest rates decrease, price appreciation on those bonds, those fixed income instruments will go up. And also it's talked about by Chris is the duration. So the longer out the duration goes, the number of average years of all the individual bonds it holds increases in time, the greater the impact. So one, it's also riskier, but also the greater the reward. So now that we're on the downward side of the seesaw, these longer durations assets will have a greater increase in performance.
Yep.
And this is how we're actually just made these adjustments as part of our quarterly investment review and allocations. So one of the things that we did, and like Chris mentioned, y'all probably might have seen the recent trade confirmations on the trades, is we increased the duration in all the risk models that hold fixed income. So basically all of them except for the most aggressive growth. We took the existing bond fixed income portfolios and we increased the investment selection that increased the duration out. And then subsequently, as rates go down, should improve the overall return. And we will continue to do this as we go through. So as the Fed continues to progress through each of their 6 meetings or their meetings every 6 weeks, we'll continue to look at this on a quarterly and an intra-quarter basis to see if there's any adjustments need to be made as the interest rates are updated or changed. From the equity side, this is the growth side of things, stocks. We did a partial allocation shift going from the large cap, the mega large companies like the Magnificent Seven and the S&P, to the small and mid cap. So as the rates decreased, the small and mid cap companies can either borrow money or refinance some of their debt that they may have acquired during the period where we had rising rates. So it should be a more favorable environment for the mid and small cap companies. So we made a small allocation change, shifting just from U.S. standpoint from large cap to mid cap. And just like in the fixed income area, we continue to monitor this. We do our full comprehensive review every quarter, but in between things, we're looking at things, and if there's any need to make adjustments, we'll do so for the allocations.
Okay. So with food for thought, this is back to Steve Jobs. He would make a presentation. One more thing. So we'll leave you with some food for thought, which is not to let the results of the election affect your investment strategy. We all know half the country is going to be happy, half the country is going to be miserable, or the other half of the country is going to be happy and the other half of the country is going to be miserable, no matter who wins. You don't want to allow that to affect your investment strategy. So this is a slide from Schwab. It goes all the way back to 1961, minus an unforeseen event. So for example, within the 1970s, they call that the lost decade. There was a lot of inflation during this time, and there were 2 major economic sort of issues at that time. Under when you see here 2000, so this is the tech meltdown here in the beginning of 2000, and then here's the mortgage crisis here towards the end. Separate from something unexpected, you see this trend is largely upward. And our main focus is your long-term financial plan and the long-term health of your goals, essentially. And so we don't want your investment strategy or for you to doubt your investment strategy because of whoever gets elected. So that's the one piece that we wanted to start with. And then the next piece has to do with volatility. And so this, just to sort of unpack this slide a little bit, this green slot or graph is the historical average of the 4th year, typical election year. And then the blue is where we are this year so far. And so you see how this blue is down here on the bottom, which means it's been less volatile this year than in historical averages, minus this flare up here over the summer. And so what we're expecting is, okay, the election is Tuesday. It'll come down, the volatility will remain elevated, and there may even be a little bit of a blip or a flare up here right around Thanksgiving. Still remain elevated, but come down some, and then maybe another little flare up after December 15th, heading towards and into the end of the year. So we're aware of this. We're wanting to make you aware of this so it doesn't affect you. There's a saying, the only time people are disappointed are when expectations are not met. And so we're trying to manage expectations here to say volatility will be higher in the next, call it 60 days, and for you not to be surprised. So those are a couple of things for you to keep in mind as we come to the end of the year here. All right, so we went a little longer, 12:40 here. We're going to begin our Q&A session. So starting with the first question, as we approach presidential elections, do you expect much change in our portfolios depending on the outcome of the elections? And not necessarily. We're not going to change based on who gets elected. Both of these candidates, and Brian, I'm definitely interested in your input here. Both of these candidates have a plan for growth. I mean, we started the presentation telling you how the economy is good. There are lots of parts of the economy that are good. And both of these candidates have plans to continue to stimulate the economy, albeit in slightly different ways. That wouldn't affect your portfolio. The thing that we're more focused on is interest rates. As interest rates go down, we see that as an even bigger opportunity in terms of managing the portfolios. So Brian, let me let you, what are your thoughts on this first question?
It's really the same. I mean, kind of like we on the food for thought, really, whether it's blue, red, purple, the presidential election really, doesn't affect the market per se. I mean, if we did, have an increase, a large increase in deficit spending, that may impact economic wise, but doesn't necessarily mean it's more of a factor, not necessarily who's in the presidential seat, but just in general. So, like you said, the Fed, who is supposed to be party neutral, the Fed and they're controlling the interest rates is more of a factor overall, impacting the portfolios versus who's actually in the office itself.
I like this next question. Can you explain why deficit spending is a concern? And I like this question, makes me smile because you can make a case to say it's fine. And part of that is true, in the sense that our government debt and what we issue, so we have about $35 trillion of debt, as it if you were to add it all up. The issue is, or the concern would be, that if we continue down this trend, that people will not continue to buy our bonds. Now, I actually have a whole nother slide from another company. It was that would suggest there would be no concern about, and I can bring that up here, about continuing to issue our bonds based on the strength of our country. So, for example, this is the U.S. is not a bad credit risk. We have 34 trillion in liabilities. We have $200 trillion in assets in terms of future taxes and all these different assets that we have: land, oil, natural gas, coal, military assets. So the sort of textbook answer is that we should balance the budget. We shouldn't spend so much. maybe there's more waste in there. So when you break down the budget, for example, you see Social Security is 21% of the budget and Medicare is 25, so 46%. So half the budget is gone already just to fund Social Security and Medicare. So I think Medicare and Medicaid are sort of like a classic. There's a lot of waste here. It'd be nice if we could get our prescription costs down. Like we subsidize, I swear, the world with how much we pay for our access to healthcare. But Medicare itself is great. I mean, we work with retirees. They love Medicare. Medicare is fantastic. It's just expensive, sort of on the back end. Okay, defense spending. It's not like we're going to be reducing our defense. We've got arguably the best military and the best Navy by far in the entire world. So I guess I'm kind of going off here, but the point is that if we continue to have deficit spending, the concern would be that people would stop buying our bonds. But I smile to get the question because part of it would suggest that it's okay. Lots of other governments do this. We all issue our own bonds, and so long as they pay interest, people are happy to own them. So let me pause there, Brian. Let me get your thoughts. What are your thoughts as it relates to the concern around deficits?
I mean, really, I mean, pretty much echo everything you said. The only I guess concern is like if this deficit spending keeps increasing, while the interest rates are going down, if the balance of the deficit is going up, this net interest we're spending may not go down as much. So the thing is kind of a cyclical effect is the more deficit, the more bonds and stuff, treasuries that we issue, then we potentially increase this over here. So it kind of gets in this vicious circle. But I mean, I echo exactly, I mean, everything you're saying.
Well, we would have to sell bonds just to pay the interest, which is like the definition of a Ponzi scheme.
Yeah. So
kind of thing. Okay. But yeah. Good. Another question, please keep them coming. My insurance has increased by almost 50% over the last year. Yes, homeowners and auto insurance. Everything seems more expensive, from water, consumer goods, cars, any scenario that you see where prices come down, or do salaries need to catch up? So within the couple of things, just to unpack that. So cars are more expensive now, and they're more expensive to fix. There's more technology in these cars. And that's part of the reason why auto insurance has gone up, is because the claims and the whole process to get a car fixed just costs more now. And people are having more car accidents than ever, which is probably because of the phone, and they're distracted and they're crashing their cars in broad daylight, which is a head scratcher every time. But the combination of those things, which is why auto insurance is so high. And then the other piece on the homeowners insurance, and especially down here in Texas and Florida, is because of all these storms. So I don't know that trend will change. I mean, that's an issue. In terms of the consumer goods, I did see, and Brian and I talked about this earlier this week, is that we're starting to see things go in the right direction. So there was an excerpt about how at the grocery store they're starting to add, like, things are going to, rather than the price either rising and or the size of the whatever it is you're buying shrinking, it's like they just put less in the bag. I did read an article or an excerpt earlier this week that we're going to start to see, the amount that we're getting at the grocery store to start to rise. Brian, let me get your thoughts. I think this is a great question. What are your thoughts here?
yeah, I mean, of course, I mean, this auto insurance, actually, this is the inflation chart was broken out. So, definitely have, I guess, in the CPI components, auto insurance was a big factor. I think maybe 2 quarters ago, it was like 22%. It rose 22%.
Mhm.
So as you can see, this red over the past year and a half, 2 years, all of a sudden where insurance was not a factor, it was actually a larger factor within the CPI. So that's definitely recognized, as well as homeowner insurance with all the disasters we've had over the past couple years. In some markets where carriers have been leaving, rates have definitely gone up. Core goods in general, I mean, at Grant Select, we could break this down into more granular detail, but core goods in itself has been declining, been in a disinflationary type pattern as far as over the really for the majority of the past year. So while food components, both food at home and dining, continue to be part of the factor, some of the other core goods, prices of cars and stuff have come down. So you know that still may, as we keep progressing, wouldn't be surprised if this orange keeps staying on the deflationary side.
And then the last point, do salaries need to catch up? So that would be a yes in that regard. So you'd want to see salaries rising more than 2.5%. So making sure that the person is, if they're still working, they want their salary to grow by more than inflation. And for retirees, we factor in a 3% annualized inflation rate, which is the 100-year average. And when you have years like we've had from a growth standpoint, the last 2 years have been very good. So when you look at your portfolio, you'll see some healthy balances there, and that's part of the growing economy. So definitely worthwhile to shop the homeowners and auto insurance, and we have a list of brokers. So whoever this person is, feel free to email us and we can send you our list of brokers so that you can shop your home and auto insurance and see if you can cut down on some of that expense, because it's certainly worth the effort.
Yeah, and this just to add to that, we didn't include it in this quarter's deck, but right now as far as of the end of September, the wage growth overall was still at 3.9%, so well above the 2.4, 2.5 inflation rate. So wage growth continues to outpace, or has been recently outpacing inflation. So you're seeing a real income component as far as the wage growth. So as long as that trend continues with the inflation going downward or just staying level and wage growth still being well above that, and hopefully that will help folks bear the impact of any inflation factors.
If your salary's not gone up by 3.6% in the last year, then you'll want to start to push for that. All right, it looks like we've got to the end of all of our Q&A. Thank you each for your participation and attendance. Let us know if we can help further. That's what we're here for, and we'll continue working in the background. And have a great rest of the year, and we'll continue our work here and see y'all in January. All right, talk to you later. Bye-bye.